What's up, everybody? It's Rashad here, and today I want to talk to you about 3 stocks that I plan on buying in 2024 and what price do I plan on buying them at. With no further ado, the first one is Google. Now, unless you've lived under a rock, I don't think Google needs much of an introduction, but if it does, Google is the #1 search engine in the world, and it actually owns the #1 and #2 search engine because you're probably on it right now, which is YouTube. It also owns a plethora of other businesses and is currently valued at over $1 trillion. So let's look into some bull and bear cases for Google stock. The first bull case is it has a rising number of YouTube Music and Premium subscribers, which exceeded 80 million at the end of 2022. The fact that they have over 80 million people subscribed to subscriptions is amazing because subscription revenue is one of the most dependable forms of revenue that there is. Every single month they know exactly how much they'll make from these 80 million subscribers. And I'm even one of them. I have YouTube TV, and YouTube TV has turned into one of the largest cable providers in the country. Number 2 is the expansion of Google Cloud. The cloud business is extremely profitable and it has huge margins to it. And their cloud business is currently growing faster than Amazon and Microsoft's right now. However, Amazon and Microsoft's cloud business is currently larger than Google, so Google has some room to run. And lastly, they're making huge investments into AI, and they are cost cutting, which is increasing cash flow. And that is amazing for investors because every investment is the present value of all future cash flow. So the higher Google's cash flow is, the more you should be willing to pay for it. Now, what are the bear cases for Google? Number 1 is its core search engine could become less relevant to advertisers due to the growing popularity of ChatGPT. And this is huge because half of Google's revenue comes from Google search. Small to large businesses pay Google in order to run ads on Google search. So if Google is getting less and less searches because people are going to ChatGPT instead of searching in Google, then there's less money that they can make. And secondly, YouTube's ad revenue only rose 4% year over year in the second quarter due to competition from TikTok. Nowadays, people have a ton of different options when it comes to entertainment, and TikTok has definitely taken some business from Google and the company that we're going to review next, which is Meta. But before we look at Meta, let's look at Google's fundamentals and see if they pass my 5 factors for a good investment. So I'm here at Ticker Terminal and I have Google already on the screen, but the first of my 5 factors is a price to free cash flow below 30. This is simply a valuation measure, and we just want to know how expensive is Google stock compared to their free cash flow. If I look at market cap divided by free cash flow, Google is currently at 23 times its free cash flow. So that is a check. The second thing I want to look at is, do they have growing revenue and cash flow? So we'll head over here to detailed financials, and here is the revenue. 5 years ago, they did 136 billion, and then in the trailing 12 months, they've done 297 billion. So that is definitely a check. Now we head to cash flow, and for free cash flow, they did 22.8 billion 5 years ago, and the trailing 12 months they've done 77.6 billion. That is a check. Now let's see if they have a return on invested capital above 10%. I'll scroll up, head to ratios. Return on capital is currently at 26.8%. That is perfect. That is a check. Our 4th factor is current assets over current liabilities. So we will head to the balance sheet. We'll scroll down. Total current assets is at 176 billion. And total current liabilities are at 86.2 billion. That is a check. And the last thing we want to do is look at shares outstanding. Now, typically you want a company buying their own shares back because it gives you a larger piece of the pie. You own a larger percentage of the company when a company buys the shares back. And it also works on the opposite end. If they are to issue more shares, then they are diluting you as an owner and giving you a smaller piece of the pie. And so we want to make sure Google is not doing that. So we'll scroll down here. And total shares, 5 years ago they had 13.9 billion shares, and during the last 12 months they have 12.5 billion shares. So they have decreased those shares outstanding, so that is a check. They are giving their owners a bigger slice of the pie. So now that we know that Google hits all of our checks fundamentally, now we need to determine what price should we pay for the company. And although Google hit all of my standards, I always want to pay a cheaper price if possible. In order to do that, I use stock options. So let's head to Thinkorswim so we can look at Google's options chain. So I now have Google pulled up and it's currently trading at a stock price of $130. But let's say I want it cheaper than that. What I could do is sell a put. When you sell a put, you give the buyer the right to force you to buy the shares of the company at that stock price if the price drops below the strike price by the expiration date, which that is perfect if you are actually using this strategy on a company that you are fine with owning anyways. So Google is a company that I want to buy in 2024. So we're over here at the options chain. Now typically when I sell puts, I go at least within 30 days. So I'm gonna go to January 12th here, that's 29 days from now. And we look over here on the put side. Now normally when I run this strategy, I go for a delta of 0.15. And you can see delta on this right column here, but delta is simply the probability that the event occurs. So if as a delta of 0.15, they're saying that there is a 15% chance that the stock price drops to that strike price by the expiration date. So if we look over here and we scroll to a delta of 0.15, we can see that is at the strike price of 123. So if I sell to open this contract, I will be obligated to buy the shares if the stock price drops down to 123 by the end of the day on January 12th. And every contract is worth 100 shares, so I will be forced to buy 100 shares of Google per contract. So if I was looking to place this order, I would come over here and I would select the amount of contracts that I want. And let's say we're going for 1 this time. And the midpoint between the bid and the ask is currently 0.71, which means I will receive $71 for fulfilling this contract. And when you sell options, you receive the money up front. So I would receive it as soon as I filled this order. But if that looks good to you, you hit confirm and send. And that is Google stock. So now let's take a look at Meta. Now Meta is also a company you should be very familiar with. Meta is formerly known as Facebook, but they own Facebook, Instagram, WhatsApp, and Facebook Messenger. They are by far the largest social media company in the world, and over 2/3 of the world's population uses their products every single month. Now let's look at the bull and bear cases for Meta. The first bull case, revenue has increased 12% year over year to $94.8 billion in the first 9 months of 2023. So although they are a huge company, they are still growing at a pretty rapid pace. Analysts had previously predicted that they would only grow at mid-single digits, but they are still doing double-digit growth year over year, and who knows what that could look like once they start the metaverse. Secondly, digital ad markets anticipate growth to grow to 1.26 trillion by 2032, and Meta owns about a 23% of the digital ad market. So as the total addressable market continues to grow, Meta's revenue should grow with it. And lastly, WhatsApp. WhatsApp is a hugely popular app pretty much everywhere in the world other than the US. Most people in foreign countries use WhatsApp nearly every single day. And Meta has yet to figure out how to bring in much revenue from WhatsApp. So once they figure that out, the revenue is going to grow tremendously. But now what are the bear cases? They are currently facing allegations for its ad-free subscription in Europe. The European Consumer Organization and 18 affiliates lodged a complaint alleging it violates EU consumer laws. Now this is nothing new to Meta. They face backlash pretty much ever since they became a company. Mark Zuckerberg seemingly always has to defend himself and the product, which is Facebook, and they always come out top every single time. There's just changes that they have to make. So although I put this in the bear case, I don't really see it being a huge hindrance to them making money. Now I've already checked out Meta's fundamentals and they hit all 5 of my factors. They have price to free cash flow below 30, they have growing revenue and cash flow, return on invested capital above 10%, their current assets is larger than their current liabilities, and they are buying back shares. So let's take a look at the options chain to see how much we should pay for Meta. So here we are again in the Thinkorswim platform, and I have Meta now pulled up, and we're going to stay with the exact same expiration date that we looked at before, which is January 12th of 2024, which is 29 days from now, and we're going to stick with the same delta of around 15. All right, so if we go over here to the delta column, it looks like the closest to 15 would be the 305 strikes. And it looks like if we wanted to sell this contract, we would get paid around $190 to do so. And so as long as Meta stock price stayed above 305 by the expiration date, we would just keep that $190 and we can move on with our life. However, if the stock price dropped below the 305, then we would be forced to buy the shares of Meta at the strike price of $305. And every contract is worth 100 shares, so we would have to purchase 100 shares of Meta. Now, as you can see here, you can be more conservative if you like. I can do the strike of 275, which only has a 2.8% probability of having. But as you can see, the further away you get from the stock price, the less and less money you'll be paid. But again, if you were comfortable with that, we would just come over here, make sure the side says sell. You can select how many contracts you would like. I'll select 1 for now. And everything else looks good. Hit confirm and send. The next stock is PayPal. PayPal is another large company that you should be very familiar with. However, if you're not, PayPal essentially allows you to buy and sell items and services online. The first bull case for PayPal is Venmo's increasing popularity. Now, Venmo is just another app that allows you to pay and get paid, but it has increased in popularity greatly since PayPal has purchased it. And Venmo has a reputation of being more secure than other apps such as Cash App. Secondly, they have a brand new CEO named Alex Chris. He's a former Intuit executive and has been building a new executive team with people from Intuit, Walmart, and American Express. Now, he was just hired in August of this year, so it'll take some time to see how the changes that he is making pan out. And thirdly, they have great fundamentals. Now, some analysts have panned PayPal out to be a dying company. However, if you look at their cash flow and their revenue, they are increasing both of them, so really they are a growing company, contrary to popular belief. The only bear case I can think of for PayPal is their growing competition in the digital payment space. It seems like every company is coming up with their own way to pay digitally. You have Apple Pay, Google Pay, Samsung Pay, and a host of others. And more will continue to come up, which will take more market share from PayPal. However, thus far, they have shown that they can continue to grow their revenue and their cash flow. And with that being said, they have hit all 5 of my factors as well. So let's skip that part and see what price should we pay for PayPal. And here we are with PayPal pulled up. We'll stick with the same expiration of 29 days for now, and we'll head over to the delta. We want a delta below 0.15, so it looks like the strike of 57 would fit that bill. And for selling this contract, you would get paid $40, and if the stock price stayed above $57 by January 12th, then you keep the money and move on. If it drops below $57 by the expiration date, then you're forced to buy 100 shares of the company. If you'd like to learn more about options and see how I trade options to generate multiple 6 figures per year, you can join our Trade to Freedom community and course, where I show you my exact strategy that I use to generate thousands per week. And I even publish my exact trades in real time. Well, that's it for this video. Remember to always do your own research and let me know in the comments if you're interested in Google, Meta, or PayPal. I'll see you guys soon. Peace.